Welcome to TheoTrade. This is Don Kaufman doing the weekend update. Here we are, April 30th, 2016. Question that looms large this weekend, is volatility back? Everywhere I looked, from mass media to any type of financial reports, we're talking about the market selling off fairly big over there. I have to tell you, I'm going to try to give you the most objective view possible of the last few days of trade and what I see ultimately moving forward. So we're going to start kicking it off here in the SPX. And again, only going to give you a brief recap of what ultimately went on last week, because if you've turned on any media, I've been Facebooked to death. I don't want to hear about Apple anymore. Are they going to make money? Are they not going to make money? Okay. I'm sorry, Apple. You can't buy cool. Google, all right. And of course, Amazon, which is crushing the entire world. Enough already. Their earnings, right? They move inside the expected move or they go outside of the expected move. Nothing more, nothing less. The larger, again, question that looms is volatility back? And I'm going to give you, I think, a very different perspective of the last few trading days. So what I've done here inside of the SPX, and again, I feel it's much more pertinent to look at the broader markets when you're asking a question like, hey, is volatility coming back? Forget about individual underlyings for right now. So here we have the entire week, 1, 2, 3, 4, 5 trading days. So 5 trading days. And everywhere I looked in the media, they kept talking about like, oh, volatility, it's like one of the worst weeks we've had. Now, that may be true inside of the NASDAQ, and I'll look at the NASDAQ in a moment. But first, let's take a look at the SPX. And there's something very specific I want to show you is I looked at what the markets were expecting, quote unquote, expecting the market to move. And then I looked at actual movement. Okay. And when I say expected move versus actual move, I looked in, the expected move, and we'll call it EM. All right. The expected move, that is going to be derived from implied volatility of options. And then I looked at the actual move, which is looking at the price chart, right? It's like after the fact. Great. Hindsight is always 20/20. And I thought, let's not even look at the full week because we kind of rallied a little bit and then dove off. I actually kind of looked like midweek. And I gave expected move kind of the benefit of the doubt and looked at the most extended portion of the move. And this is what I found. It's going to surprise you because the entire marketplace is talking about volatility again. And what I found is I went into Think Back, which is just backed data, right? It's just end of day back data. And here we are on 4/25. And if you're not familiar with the calendar, it was actually this past Monday. So it was Monday night's data. And I looked at the 4-day options. Why did I pick the Monday night? Again, I tried to give it like the benefit of the doubt. And what did I see? So this is where we closed on, again, that fateful Monday, which was April 25th. The expected move, which is derived from what? The implied volatility, was right around $25. Okay. And then what did we actually move? Well, we moved from 20, right? 87 to where we currently are, which is 20, what? 65. The last time I looked, that's well within a $25 expected move. So again, you have the market pundits. It's coming. Volatility is here. And I'm sorry, the expected move had this right. One of the telltale signs of volatility is when you smoke your expected move. An expected move, and again, if you're not familiar with it, and we've done a lot of stuff here at TheoTrade on it, but the expected move is, in this case, 25, and that accounts for 68% of all occurrences. Now, if we moved like $50, talk to me, right? $50, then you're like, woo, that's double the expected move. And that's what they call, a 2 standard deviation move. That's what 68% of the time equates for a standard deviation. So a $50 move would be what we would term statistically a bit more significant. And you get out to like, 3 standard deviation moves. You just multiply it. It's that easy, all right? And you go 1 standard deviation, 68% of the time. 2 standard deviations, okay, counts for about 95% of all occurrences. 3 deviations, about 99% of all occurrences. When you start getting out here, okay, so that, double the expected moves and so forth, then it's kind of like, all right, it's getting a little bit serious. The way I look at it, and again, I gave the market the benefit of the doubt here. The way I look at it, not only isn't it statistically significant, all we did was pull back a little bit. Is there anything else, though, that can help us in this particular case? So I can go over to the NASDAQ, all right? And the NASDAQ is, it's a little bit of a different animal. And I'll pull up some of the back data in the NASDAQ, and I'm going to do the exact same exercise here. So, and the reason I'm doing this is because this is going to answer your question for you, and it's going to give you, all right, a much better interpretation of what to expect moving forward. I want to make that absolutely clear. Why I'm showing this is, hey, listen, you want to know what markets are expecting over here. You better know, all right, have they really smoked through their expected moves and so forth? Is it getting that much more serious? And as of right now, if you take a look at the NDX, the last, trade, and again, we're on that same date of the 25th, it was expecting about a 71-point move with about 3 days to go to expiration. And we were right at about 44.74, right? So it makes the math pretty easy at that point. And if you do take a look, and you got to look at specifically the NDX. Is the NDX below 4,400 right now? And we'll just go over here and you'll see 43.41 in this particular case. Now, that's getting a little bit more entertaining. So again, you got to read between all the garbage about it's Apple is coming apart at the seams, it's Google, and I'm going to talk about Google momentarily here. The NASDAQ is making, a bit more of a substantial move because, again, on Monday evening, it was trading at 44.74 with a $70 expected move. Where did it end up on the week? A little bit more serious, 43.40 in that neighborhood, which is almost a 2 deviation move. Now, again, we didn't totally smoke through it, and the NDX specifically, it felt the brunt of the move inside of Apple, inside of Google over there. So maybe that's a little bit of an anomaly, right? So you got to dig even deeper. Because again, one product says, no, we're well within normal range of volatility. The other product says, yeah, it got a little bit more serious. Last but not least, and if you've only been watching TheoTrade for a short amount of time, you might not know much about these little guys. These are the volatility futures, and the volatility futures can be incredibly insightful, not about looking at the past, in about the present. What the volatility futures can tell you is, pretty straightforward. Here's an 18-day volatility future. It's trading right now, for 1687. Then forget about all these weeklies. They don't even exist. Get rid of them. Then look at the 46-day, and it's trading right now for 18.97. Basically, it's trading almost for $19 over here. So if you take a look at this, what it really says is, here we have June, and again, June, let's just round it, is trading for about 19. 19% volatility. What do we have May? May is down here trading for, and again, just all you got to do is round it. And we're actually going to give it the benefit of the doubt. We're going to round it up over here to 17%. There is still, a 2-point differential between May and June. Now, anytime you're in the midst of more extreme volatility, what you will see is you'll see short duration volatility futures, first come right up equivalent to the June volatility futures, and then finally exceed them. And this is actually what you term contango and backwardation. Contango and backwardation. If you're not familiar with the terms, it's okay. What you want to look for, if you think you're going to be in extreme volatility, and you better be looking for this next week, you want to look for these short duration vol futures to start to exceed, the longer duration vol futures. What that means, risk is imminent. Risk is here. What are we seeing right now? Right now, nap, nothing. As of right now, the move that we're seeing is nothing. However, we definitely picked up. just a bit. Again, the volatility futures, it's /VX. That's specific to thinkorswim. Only look at the 18-day, the 46-day, which is the standardized contract. Get rid of all these other, you see these volatility futures, they don't even trade, all right? They don't really trade. They put weeklies in there. But again, the standardized contracts, they do trade and they matter. And it matters where one volatility contract is versus the other, because if May is higher than June, it means, boom, the markets are off the handle, off the hook, all right? We've actually gone into a period of volatility inversion where the risk in the short duration is literally greater than it is in the longer duration, which sounds crazy, right? What do you think of risk and you go, well, what has more risk? The next 5 days or the next 6 weeks? And everybody goes, well, the next 6 weeks, because there's more time, there's more uncertainty. Yeah? Well, imagine when the volatility futures flip over and short duration has more risk. It goes, and just to tell you, that ultimately says like, oh, it's crazy. Right now, this is very, very normal. There's a 2-point differential between May and June. It's not displaying risk. Now, moving along. There's one other area. You better feel comfortable with all this stuff, right? There's one other area you got to look at. It's the VVIX. The VVIX, it's the volatility of the volatility index. It got a little bit heated today. Okay, and that's, I should say, yesterday, but it got a little bit heated. And you're looking at a 9-month, okay, a 9-month over here. And the one thing I do want to point out, and this may actually surprise you a bit, but on the 9-month, yesterday, which is Friday, and we rallied back up into the close on Friday, okay, it actually got a little bit heated. And what this ultimately says, it says the risk of volatility moving more is increasing. What that says, all right, ultimately, it's the volatility again of the volatility index. I just love saying that. Ultimately, what it's saying is how fast is risk really moving? If you look at the VIX, and lots of people look at the VIX, right? You look at the VIX. VIX is ultimately the risk, all right? This is the risk of the risk. How fast is that risk moving? And when this instrument, the VVIX, starts to get like north of 100, okay, put your helmet on. We're going in. And you better think about that because, again, it starts to get north of 100, you're going in. Whether you like it or not, you are going in. It gets to 110, and that's like you better be hiding under your desk at 110. These are all items we're going to be looking for this next week. One last thing in terms of an equity over here. Google. Eyes on Google. Eyes on Google. Google L is what I'm looking at specifically. The reason I say eyes on Google, it's a pretty key area over here. Not so much, okay, like in support and resistance. People are all about support and resistance. Google is a behemoth market cap. Apple is already broken down. Okay, Apple's getting smoked right now. We're aware of that. Google, however, is actually facing January and February lows. So when you were panicking back in January and February, well, guess what? That's where Google is trading right here, right now. Google cracks under 700, so goes the market. You better look for it this next week over here because Google, you're only 8 points away from it getting very, very serious. Now, we could dip below it for a day, dip below the 700, and then rip them higher. Again, we want to see signs of risk out there. Earnings, they're not front and center anymore. We're past the more exciting earnings plays, and people always look at earnings. They're going to tell us a lot. What have they told us? What? Tech isn't doing so good. Great. All right, Google, you got to look at Google as the GE of our era over here. And when it's not doing well, the market cap alone can pull us. So you also have to recognize the other behemoth in market cap. Here is Apple, once again, right facing into January and February lows. Okay, wouldn't surprise me to see Apple in the mid 80s over here. It is not currently in favor with the marketplace. Keep that in mind. So as you move forward into this next week, right, and this is what's, again, kind of important over here. We move forward in this next week. I'm going to go specifically to the SPX. The SPX gives us a pretty good litmus test for what is being expected. As of right now, all right, you get a Wednesday expiration and a Friday expiration. I look at both, okay, 13%. Almost 15%. There is a jobs number coming out on Friday morning. Jobs number coming out over there. So expect the implied volatility to maybe pick up a little bit as the week progresses. But we're only looking right now at a $33 expected move. Once again, nothing too significant. Nothing too significant. One last item here coming into next week. So we're a $33 expected move, right? Where the rest of the world is in the duck and cover kind of mode over here. We're looking at the VVIX. It's not showing much yet. It's not to 100. We're going to be looking at the volatility futures. There's still a 2-point differential. When the volatility futures from May to June are equivalent, it's getting more serious out there. We're also looking towards the expected move in the SPX. Okay. What's it at? 33. Well, that's not very exciting over there. We're going to look for an increase of expected move as the week progresses. These are all to help you determine, is volatility ultimately here? Thanks, everybody, for joining us here at TheoTrade. I'm Don Kaufman. Beyond all throughout the course of this week, lots of trades to do here at TheoTrade. In the course of the week, put on lots of positions, took off lots of positions, much more coming. Thanks, everybody. Have a great weekend. Bye-bye.